I felt the urgency from the continuing climate crisis that we see all around us, and I wanted to know more about next steps. As I reflected on our quick testimony of stewardship in the earth, it occurred to me that it was worth looking at what our investments are supporting, from the idea of divesting from fossil fuels to the support of green technology. I knew very little about investments and quickly became aware that this is a complex issue. As part of working with the Climate Justice Working Group, Peter Close and I decided to bring together others that have done work in this area. Peter has invited friends from Saratoga Meeting and New York Quarter, as well as Friends Fiduciary, to share their journey in greening investments with us today, so we can all benefit from their experience. So Peter, I pass it to you.
Thank you, Sally. I want to welcome everybody today. And we have, just want to mention, we have put a lot of work into this. Sally has really done a great job. Will Strayer and also Sam Cooley, all the way over in Sweden right now, is working with Will. So we have great tech support, for which I'm very grateful. And also we have a great committee, Climate Justice Working Group. Please join us if you are interested in that. So having said that, I'm going to introduce the Jim Ralston, who is the going to be on the first panel from Saratoga Friends Meeting, and he will introduce his co-panelists, and they will share with us the process they went through, their journey, going into green tech, going into the Green Fund, and then going into the Quaker Green, I'd say Quaker Green Impact Fund. And without saying anything more, they're the first monthly meeting to do that. So go ahead, Jim. Thank you.
Oh, okay. Well, we knew about Friends Fiduciary back in 2010, suggested by one of our members, and it didn't take too much of a decision to move our investments into Friends Fiduciary's Growth and Income Fund and Short-Term Investment Fund. We understood after talking with Peter Close and understanding Friends Fiduciary was developing their Green Impact Fund, that option was available. We had earlier invested in their Green Fund. We came to that decision, a business meeting,
February 2014.
Yeah, and it was probably you, Rebecca, that mentioned the existence of the Green Fund.
No, actually, it wasn't. It was Joe.
Oh, Joe Coolin.
Yeah, he was on finance then, and so when I went back through minutes to see exactly when we did it and what we did, it turned out that we discussed it in February of 2014, asked Finance Committee to bring a recommendation to us on how many of our reserves to transfer into the Green Fund. They came back in March with a recommendation. We upped it a little bit from their recommendation and then did it. But I do remember that the February meeting was very, very heated.
Now that's something that I didn't remember.
So our investment then was $11,000 into the Green Fund.
Now we have the advantage of being a very small monthly meeting. We would typically have 6 to 8 people at our business sessions. Our finance committee was a committee of 3. So in some ways, I think it's easier to come up with recommendations the fewer people you have involved. Just my personal slant on the situation. Or it's more quickly done. Perhaps that's a better way to say.
So Peter had asked us a lot of questions for us to reflect on, and about that original decision. and specifically, you know, what sort of dialogue we had had and where the energy came from, and did we consider the yearly meetings, queries, and advices. And what we realized when we were talking about it, the three of us in preparation for today, is that we had not, in fact, specifically, explicitly done any of those things. It was, we had the energy for it because it was our deeply held values. And it was just sort of built into our DNA. It was a time after we had gotten an Earth Care Witness grant to build a rain garden outside of our meeting house to help us with some drainage problems, but also to create a beautiful space. And again, it was just, you know, those were connections for us to Earth Care Witness, and thinking about what would be really, I think, a good, it really was about the energy, just the overall energy. And I think we also felt like we could afford to take a little bit of a risk with some of our money. And so while we didn't consider that Friends Fiduciary was a very risky place to put money, and we had been getting no interest on some money in the bank, our local bank, practically none. It had gone way, way, way down. So doing something that really could make a difference to the world seemed like a good thing to do with some of that money.
Well, and then too, I must say that Rebecca is our one farmer in the meeting, so she has an intrinsic connection to the earth. And I had a career as an air pollution engineer and understood the physics of climate change and what it was going to bring to future generations, including my own grandchildren.
So was Mike Lesser, were you part of this process?
I was not part of the original process in terms of the investment in the Green Fund. I've been affiliated with Saratoga meeting for about 5 years. Those decisions were made 6 years ago. But I certainly was involved in the decision to invest additional funds in the Green Fund, which we did about 2 years ago. We increased our investment in the Green Fund. We had a bit of a surplus. We had loaned money to another meeting to build their meeting house. The money was repaid, and then we had a bit more of a surplus. So we increased our investment and put that all into the Green Fund. So with the increase of our investment and the additional investments that we made, we had about $35,000, $36,000 in the Green Fund before it closed down. And then we had a little bit more than that in the Growth and Income Fund and the Short-Term Fund. So we were spread across the two funds, actually the three funds at Friends Fiduciary, the Balance Funds, as well as the Short-Term Fund. When we were very pleased with the decision of Friends Fiduciary to go green a year or so ago, when they removed all of the carbon-based investments from the Growth and Income Fund, and which made the Green Fund somewhat redundant at that point. When the decision was made by Friends Fiduciary to set up the Impact Fund, we were certainly very committed to keeping our investments green. The main decision was, were we comfortable with the increase in equities and risk that the associated risk by putting the money in the Green Fund, in the new Impact Fund, as opposed to the Green Fund, which was a more balanced fund. So the Impact Fund is all equities. So it involved increasing our investment in equities when we moved the money into the Impact Fund. We were pretty pleased with the return that we've gotten from Friends Fiduciary and the commitment that they had to sustainable type of investments in general. And the communication we've had from Friends Fiduciary. That being said, it was somewhat of a leap of faith for us to move the money from the old green fund into the impact fund because we did not have a full prospectus at the time. We've since received the fact sheet, and that would not, I don't think it would have changed our decision. So we have the information now, but we decided that we were reasonably comfortable increasing our investment in equities since we still had more than half of our investment in the growth and income fund and the short-term fund. So we didn't feel that the risk was inappropriate to what we had. So we made the decision to move 100% of our investment in the old green fund, which, as I said, was about $37,000 or so into the impact fund. And we certainly discussed it at our business meeting, but there was not a lot of heated discussion. It was pretty much a consensus without a whole lot of opposition discussion or discussion of people that
there was no opposition. There were questions, but there was no opposition. Yeah.
And there's a question on the chat. What is the definition of a green investment? And you know that is, I'm going to put my 2 cents in before I define it. And it is very difficult to actually talk about that. I met with the representative from Friends Fiduciary about a year ago when they were doing a road trip, and we talked about that. It is not the easiest thing to define, and maybe we can ask Richard Kent when he comes on and talks about it, how they define green investments, especially as far as it concerns the impact fund. But when you're talking about a green investment, are you talking about being proactive in terms of investing in renewables, wind energy, solar? Are you talking about staying away from any investments or just investments that are not carbon based? So if you're investing, let's say, in a fund that might have some investments in a company that might construct pipeline, that would not be a green investment, or would that be a green investment?
No, it wouldn't.
Questions. Or, you know, and what percentage of a fund that you invest in would you stay away from if you were trying to be green? So there's a lot of questions in that. In terms of the impact fund, we're assuming that the impact fund is specifically investments that are proactive in terms of being green, as opposed to just not carbon based. So,
but even within that, when I read the PDF that they finally sent us this week, I did note that one of the categories of investments might be agricultural, and I was very disturbed that it did not say explicitly regenerative agricultural investments. There are some very bad agricultural investments that one could make. Essentially, you know, the Monsanto style investment. So I do have questions, and we'll always have some questions. We're always going to want to be influencing them in the same way that the yearly meeting did when we said, you know, we didn't want to have our money funding pipelines and gas and oil companies. We need to be influencing this Green Impact Fund and their other funds in favor of regenerative agriculture. So those are going to be conversations that are going to continue, and they're important. But by investing in it, I think we open the door to being able to express our values and shape the future. So.
But the two, you know, as I've said, and I think as Rebecca's pointed out, the two main factors in terms of the impact fund that I think is a little bit different from the green fund and what is now the growth of investment fund is that the impact fund is all equities, which changes the mix of the risk of the investment. And it is designed to be impactful as opposed to just carbon neutral. So those are two main differences in terms of what we're doing in terms of the investment in the impact fund.
Yeah, it's meant to pull green technologies forward to make perhaps a bit riskier investment than investing in GE's wind turbine division or something to that effect.
And I don't think it would be appropriate to say that just because it's a green, a proactive green investment, that it's more risky. But it is more impactful. It can be more risky, but it isn't necessary.
Well, I think the risks to the earth if we don't do these things are a whole lot worse. And, you know, it's our, I guess it wouldn't hurt for us to talk a little bit about our goals with our money. I mean, we've used it to lend to other meeting houses for repairs and builds. We've used it to make our space work better for differently abled people and for children. We've, you know, it is our goal, actually. I mean, we've used it to keep our slate roof on our meeting house and to keep our meeting house very much in historic condition, but with some comfort improvements, but not massive comfort improvements. But I think that it is important to all of us that our money not be doing anything that's hurtful in any way. And it's also important to all of us that if we can make a difference to what the future is going to look like, that we should be doing that. So, you know, and that seems to be like a value that's pretty much held across our meeting. So,
And I don't think there's any disregarding the fact that as temperatures go up, you know, those in the less developed world and closer to the equator are going to suffer most from heat-related deaths and illnesses and infections of all sorts. There's going to be a planet-wide migration towards the Earth's poles. So to the extent that we can mitigate that, we're looking to do that.
I think that yeah, somebody had asked earlier in the chat what climate justice was about, and that's a part of it, is that we really clearly see in our meeting that there's this combination of social impacts and environmental impacts that run together. And so it's, you know, it's a witness thing. That's what I would say. Yeah, I'd be open to questions. I mean, if there's something that would be, we did go back and look at the queries and the advices, and we were thinking that they could use some more work. There's something nice on page 109 in the new Faith and Practice that says, in making investments, meetings should bear in mind that the way investments are made can sow seeds of violence and be hurtful to society. Therefore, in considering investment possibilities, they should weigh not only security and rate of return, but also the conditions under which income will be produced, in order that friends may not, even unwittingly, be profiting by human oppression or the despoiling of God's earth. The discovery and promotion of socially and economically beneficial enterprises are prime objectives of Friends Investing. So to me, that's the single most effective place in Faith and Practice that has to do explicitly with investing. And I would hope that any meeting that read that paragraph would be seriously considering changing how they do their investments if they happen to be fortunate enough to have money. But I know we are not the only meeting in the yearly meeting that has some money. There are some without, and they should be borrowing from the rest of us. And there are some with, and we should be using it very, very wisely. My opinion.
So one of the questions in the chat has to do with the criteria for evaluating green investments,
Yep.
which I think would be a perfect question to pass along to our Friends fiduciary representative, who we expect to be present. And can anyone recommend investment vehicles and services with similar principles and commitments for individuals. Well, Peter and Sally, I think, are working toward that in a future workshop that we intend to hold in a month or two.
Yes, that I hope will be coming up soon, and we will not make any recommendations. What we will do is we will follow the same format. If we don't think it's appropriate for us to recommend anything, but we will say this is where we will have individuals say, yeah, I didn't know anything about this, and gee, I looked at my investment managers, and my people handled my money, and they didn't have anything for me, and so this is how I made my move into green investing. So that will be our next one for individuals. But once again, we don't make a recommendation. We will just tell you how other friends approach this, just like Saratoga monthly meeting. This is a real monthly meeting. This is the process they went through. You're not going to get it any more clearer and open than you'll see right here. So we have a couple more minutes, or a few more minutes, so we can continue with more comments. And
I'll just add to that, Peter, that we would welcome anyone that has suggestions to that question about a vehicle for individual, because we don't have all the answers.
Please put that in the chat. Yeah.
Yeah, there's already a few chat messages that people have sent on that.
Yeah, it's great.
And
Please share us
these
your
are not
ideas.
recommendations necessarily.
They're what other people have found to do.
Yes, exactly. We are not recommending anything. These are simply things we've
We do
done.
not make recommendations. That's you. You have to take that leap. You have to listen, and you have to make that decision. You don't. But that's well, excellent. I guess if do you have more time, Michael, Rebecca, or Jim? Would you like to make a couple more comments, or?
Well, I'm noticing that we have some other friends from Saratoga Friends on the call, and I'm wondering if any of them have anything that they think that we neglected to say.
Okay, well, since I don't know who you are, you can unmute yourselves and share at this point. And just to say, maybe say your names, that'd be good, although we can all see them anyhow. Oh, I guess not. I don't want to put anybody on the spot by calling them out. So
I will say, in connecting with my members of Congress recently, I became particularly mindful of query 10 and 16 and advice 17 in our updated faith and practice, which has to do with our connectedness to the larger world around us.
excellent. Well, I'll throw one thing in, and that was when I was on my way to my one-man vigil for Black Lives Matter Saturday in the snow. I got a phone call from Steve Mulkey, who's down there somewhere, and he said he'd like to rewrite part of our announcement. And our announcement originally started off, if you saw the earlier ones, with are your meetings investments in accord with friends testimonies of stewardship of the environment. And what Steve said to me on the phone as I was driving off in the snow, he said, I don't think there's agreement as to whether there is a friend's testimony of stewardship of the environment. And I may be paraphrasing him the wrong way, but that also will be a topic. That's something we do. Is there a friend's testimony of stewardship of the environment? And if so, what is it? So that's a question I would leave everybody with, that to share, and that can be a dialogue. So anyhow, having just spoken more than I wanted to speak, we probably have time for one more comment.
If there's not a testimony on that, then I don't understand why we would have advices and queries on that very topic. So advice 17, we are encouraged to pay attention to such concerns as population growth, climate change, sustainable energy policies, and right sharing of natural resources. That implies that when we reached agreement to give that advice, that Friends saw that as important. Query 10, do we support measures to avoid pollution of air and water? Do we support measures to establish the conservation and right use of natural resources? Ditto. Query 16, Are we engaged in nurturing and deepening our relationship with all creation? Do we make time to open to the spirit through contact with nature? Do we strive to live in harmony with the earth? How can we transform our lives in witness to our right relationship with the earth and join with others in active stewardship, realizing that we share one planet now and in the future? That's testimony.
Well, thank you. And I think I hope we could have this discussion in the chat at the end, Rebecca. And I hate to put Steve on the spot, but I know Steve pretty well. And so he will get plenty of opportunity to respond as to exactly what he meant and explain how I must have misquoted him. But I have but anyhow, it's very exciting to me to see all this going on. So at this point, if it's okay, I want to thank Jim for really driving this thing with this panel. I thought it was Sally's idea to do this, and I thought this is brilliant to have an actual real live monthly meeting, tell you exactly what happened, so you know what you might face, and we'll be curious to hear your journey also. So thank you, Rebecca. Thank you, Jen and Michael. Thank you for getting on. This was excellent. And so now, if friends are amenable, and as I say, keep putting your questions in the chat. I'm going to, we'll go to our second panel, and that is a panel of two people from New York Quarterly Meeting. They comprise two of the members of the finance panel, finance committee, excuse me. And they will have a very interesting story to tell also. I'll just give a little introduction to them. Mike Schlegel has been on the finance committee for quite a while. He has a background in banking. He had studied at night school for his MBA, and he has run several different types of financial businesses. And presently, he's a real estate real estate developer in Brooklyn. I apologize, I haven't stopped much recently trying to get this thing together. But he's a Brooklyn real estate developer, mostly in Brooklyn. So he comes at it with a very good background in terms of business. And then Diane, I don't know who's gonna go first, but Diane, I'll introduce you to now also. And Diane she also has a long history on Wall Street. I say history, a lot of experience there. And she has also been involved with socially responsible investing. And she founded a socially responsible investing firm in 1999. And since 2012, she's been involved in investing in startups whose purpose is to solve a social problem. So I'm going to turn the Zoom over to Mike and Diane, and I'll let you go ahead.
Go ahead,
Okay.
Mike.
Yeah, okay. So I'm older than Diane, so I'll start. I wanted to just go back a ways because New York Quarterly Meeting is a little different, I think, than other meetings. A New York Quarterly Meeting is actually like a holding company. Originally, there were Brooklyn and 15th Street and other meetings. So they basically put the assets in the quarterly meeting, and the quarterly meeting managed the assets, took care of the various buildings. Also, the quarterly meeting owned two schools, Friends Seminary and Brooklyn Friends. And so we go back 15, 20 years ago, the buildings were falling apart. The endowment was not great. And basically we're surviving on the income that was generated from the investments. In those days, most of the money was sitting with Friends Fiduciary. And then we had a portion of it that was pretty much in Ginnie Mae's, because there was a requirement that 10% of our investments had to be in socially purposeful investments. So we roll forward, and because stock market largely has done well, the endowment has grown. We have separated from our schools. We are in a much better financial shape than we were in past years. And so as we've become in better shape, we started to focus more, I think, on our investments, and particularly on what we're doing for socially purposeful investments. And so we quickly saw that, just putting it in Ginnie Mae's really was not doing much good for anybody. So we started exploring, and Diane was really our main lead dog on this one, started looking at what we could do. And we first started off with CDFIs. And these are basically generating housing and support for small businesses, largely in neighborhoods that need help. And we started building a portfolio of basically loans to these organizations. We were at a point where we weren't prepared to do venture capital, but we were willing to take, somewhat risky loans for good purposes. So we have been doing that for a while. And as we dove a little deeper into this, climate change started becoming important. And so we started focusing on what can we do in terms of climate change. And so really the first thing we started to do is try to encourage Friends Fiduciary to be a little more climate friendly in their policies and their investments. And eventually that led to, I think we were one of the people who helped push the starting of the Green Fund. And I think we were the largest investor initially in that. And so we've continued to move in that direction, and largely because of Diane. And so that's how we got into green investing. And we would like to lend to other meetings. We have not found opportunities actually with other meetings needing funds. That's something that we would consider lending to. We have looked at solar farms. I have a little bit of a background in solar, and I would very much like to find lending opportunities where we would lend into solar farms. I'm actually up in the Berkshires now. I have a house up here, and I'm looking at some opportunities there. But some of the meetings own, they own land, and some of those lands could become quite useful as solar farms if they wanted to pursue that as an opportunity. Also, we have looked at some of our buildings in New York to make them much more energy efficient, and that's a very expensive, time-consuming process. We haven't gotten there yet, but that's always been one of Diane and my goals. So we may come back to that at some point, but that's where we are. And, as Diane will go into, we recently, invested in the new impact fund that was created. So I'll turn it over to you, Diane.
Okay. So I'm going to share a screen just to make sure we get all the information can you guys see that?
Not yet.
Not yet. Okay.
He may have to share the screen with you, Diane.
Oh, that's right. Hold on for a second. I have to.
No, I think whoever's hosting.
There you go. We got to go. Yeah.
Okay, good.
And we currently see your, oh, yep, got it.
Yeah?
Yeah.
Okay. So I thought since this is Manhattan, it would be a good place to start. So New York quarterly meeting is mostly the meetings in the 5 boroughs, and it has a total of $30.6 million. Mike and I are part of a team of people who the trustees rely on to decide about the asset allocation and specific investments. And Mike is being modest. He's actually a green real estate developer. He really super insulates the projects that he works on, and has implemented geothermal in his own home. And so he really does know a lot about renewable energy. So we're lucky to have him on our committee. That said, just like all committees, we strike a balance between people who want to move all the way and people who want to move less rapidly. So one thing we have achieved is that we put $5 million into this new Quaker Impact Fund, and that's mostly the amount that we had already in the Quaker Green Fund. So out of the $30.6 million we have, that $5 million is about 16.3% of total assets. In July 2020, we also participated in the inaugural issue of the Connecticut Green Bank. They call it Liberty Bonds, and these bonds are issued to help renew the assets and lever the assets that have been established by the state of Connecticut through fees charged to everybody who has an electric bill in Connecticut. There's a line on that bill that funds the Green Bank, but the Green Bank is supposed to leverage that money. And so we, by putting almost $880,000 into those bonds, are helping them speed the amount of investments that they're making in things like rebates for electric vehicles and insulation projects and all the projects that the Green Bank in Connecticut has. New York State also has a Green Bank, but we will be looking for additional opportunities. This one only paid 2% per year. So it was originally a 6-year bond, or no, a 7-year bond at issue last July. And so now we will just be accepting an interest rate of 2% per year. And that is part of our fixed income asset allocation. So, bonds are always supposed to be to protect you against the downside in the stock market, and to some degree to protect you against inflation. So we were satisfied with 2% on that investment. We also had a separate asset allocation within, so we had $5 million in the old Quaker Green Fund, and that had one green tech asset manager who was specifically looking for companies that did something green. And when people were asking what is the criteria about a green investment, most of these asset managers are looking for some technology that is associated with renewable energy, either wind or solar at scale, or they might be looking at water conservation or reduction in hazardous waste, anything that does enhance the stewardship of the earth is what these asset managers focus on. And this one, Essex Geos, invests in publicly traded companies. So they will be bigger companies. They're not going to be investing in small sustainable agriculture projects or anything like that. And so the investment that we had separately made in Essex Geos, which is actually run by an asset manager up in Boston, has appreciated to $845,000 as of November 30th, which is the date that my most recent portfolio has. And that's an additional 2.8% of our total assets as of November 30th. And in terms of how we made these decisions and why we made these decisions, I think we were definitely cognizant of the information coming from the monthly meetings. So when Brooklyn meeting and other meetings pass a minute that say that they want us to divest from fossil fuels, we take that very seriously, that it comes all the way up to the quarter and the quarter approves that minute. We are fiduciaries for the trustees who are taking advice from us are the fiduciaries for all this $30 million. So on the one hand, we don't want to lose the money, but on the other hand, we want to listen to the meetings and figure out a way that we could still not lose the money, make a decent return on the money, but also follow that stewardship mandate, really. So, I will say though, maybe some of the folks that aren't on the call right now, but there are, varying degrees of commitment for moving all the assets in this direction. There are institutions who have what they call 100% impact portfolio activation, where literally everything from their money market fund to their venture capital is green. Meaning, and everything in between. So their bonds, their large cap stocks, their small cap stocks, all of it. And they spend time looking into asset managers to determine, yes, they can make money and yes, they can be green before they will give them any of the money of that institution. So that is possible, but not everyone's convinced that that's the most prudent thing to do. So this is where we are right now. We've allocated quite a bit more than a small asset allocation to these efforts. And we're continuing to look both at what Friends Fiduciary is offering and what other opportunities we may find. Like that Connecticut Green Bank just came to us because we had been trying to figure out a way to work with them. And their bond issue came to market and they alerted us to it and we were able to react to it. The other thing that we decided as a committee, and this didn't have anything to do with greenness, but it was important to keep in mind that we had decided to pull some of the money that we had at Friends Fiduciary out of the stock market because we were feeling like the stock market's at historic highs. And with the pandemic, we were thinking, you know, the Main Street economy is not doing that well. We were very suspect of the Trump tax cuts, where they were giving a lot of money to corporations, which wasn't necessarily going to help anybody except stock investors. And so we had reduced our stock exposure because we were concerned that there was going to be a big drop in the stock market. And then that drop did happen in March of 2020, but we didn't jump back into the market. So this is often why people say that even investment committees shouldn't be market timers, but because the stock market did go to even higher heights. And so this year our returns have lagged what we would have achieved had we just stayed in through the volatility. But that said, what it enabled us to do is when the switch happened between the old green fund, which was the same structure basically with a little variation to the growth and income fund, and now it's instead all equities. What we're basically doing by putting in that $5 million is that we're reallocating towards stocks by not decreasing the amount of money we're putting into the new fund. The last thing I want to say is, even though it may seem like Ginnie Maes are conventional, Ginnie Maes stands for Government National Mortgage Association, and the underlying mortgages that go into those securities are FHA, Federal Housing Authority, and VA, Veterans Administration loans, which are given at much lower than average cost homes in the United States. So in terms of sort of Black Lives Matter and the testimony about equality, this is the last slide I'm going to be talking about is our Cdfi Investments, which stands for Community Development Financial Institutions, which are going into low-income neighborhoods and doing what was historically called reverse redlining, investing in communities that big banks had chosen not to open branches in and had not really been lending to the businesses in those communities. And so there was a law put into place called the Community Reinvestment Act that forced banks to invest, but they're really not that good at it, and they admit it. So they are funding these community development financial institutions to actually make relationships with the people in the neighborhoods and invest in small business and building up those communities. So the last thing that we did, which is not having to do necessarily with renewable energy or green tech, is we've invested in these community development financial institutions, and we put $700,000 into the National Association of Community Development Financial Institutions, which is called Opportunity Finance Network. And that one we got 2.3% interest on, and that's the per year amount. Partners for the Common Good actually was established aligned with many nuns pension funds. The nuns have been way ahead of most Quakers, frankly, in that they've been active at shareholder meetings to try to push corporations to make changes to be more socially conscious. But they also have been going around and doing syndicated affordable housing deals and community health centers and all kinds of stuff. And that's what this Partners for the Common Good does. And then Low Income Investment Fund was originally actually doing retrofits of affordable housing for energy efficiency, and they actually had difficulty doing that. So now they're just back to their typical bread and butter, which is affordable housing. And Leviticus Fund is actually in New York City, a New York metropolitan area, and we put $500,000 in that at 3%. And the last one, the top four are all domestic US community development financial institutions. And the last one is called Shared Interest, and it's a loan guarantee fund for small and medium-sized businesses in Southern Africa that are actually making investments in things like sustainable agriculture. So they're buying, for instance, investing in businesses that are brokering high yield seeds that will be more drought resistant for farmers in Southern Africa to better survive climate change. That's one example. Another example is a food manufacturing company that is preventing people from using charcoal to burn just to boil water for their beans. Instead, they're providing packaged beans so that less people will have to be sitting over their stoves. And there's many other ideas like that, but that's our one international investment. And the last thing, just to give you another example of what Mike was talking about, is that we were able to give a loan to a business that was making insulation from corrugated boxes. And this business actually had gotten a loan from the state of New York to locate its facilities up in the Buffalo area. And we were able to get a 10% interest on that because that was a new company. And they even gave us warrants for their common stock. And the common stock was valued at the time at about $5 million. And they recently did a stock issue at a $30 million valuation. Peter.
So no, I'm raising my question. Just, I think this is all excellent, and I will keep this to our time schedule. I know there are a lot of questions for everything you said, Diane. And I think you can even take, once we get into the Q&A, you can do a short wrap up there, but I want to move us now into the next thing. This is truly amazing. I didn't know but a fraction of what you were saying, Diane. This is, and I've heard you speak many, many times about what your quarterly meeting is doing. So please put your questions in the chat. I do want to keep it going because we actually, now we have a lot of material. And I'm going to turn it over to Friends Fiduciary. They do an excellent job with what they do. And that's not a recommendation. It's just that they do a great job with me, I should say. They speak to me quite a bit. I have a lot of questions. My work with New York Yearly Meeting, on their investment committee, and as a trustee, also with Purchase Monthly Meeting, and a not so active investment committee. So in any event, thank you. That was excellent, Mike. That was excellent, Diane. I do want you coming back in 20 minutes to answer questions. I'm going to turn it over to the CEO of Friends Fiduciary, Jeff Perkins, and the Chief Investment Officer, Rich Kent, who as I said, I've spoken to many times. They are great. They pick up the phone and they talk. It's not just them, almost anybody. But so thank you. And so without more, Jeff and Rich, I'll turn it over to you.
Great. Thank you, Peter. And thanks to the other presenters who've gone before. Great job. Really, I have appreciated listening to everything that's been shared so far. I'm going to share the screen with our presentation. We'll move through it quickly. We'll keep to our time. I'm going to start us off, and then Rich Kent will pick up from there. So give me just a minute to get this to where you all can view it. Screen mode, there we go. Hopefully friends can see that. Great, okay. So I think most folks on the presenting at the event today are familiar with Friends Fiduciary. A couple of things that I wanted to kind of set the context for this conversation. And that is one, we've been doing our work since 1898. We serve now over 425 organizations across the country. And it's also important to note across the theological spectrum of Quakerism. So we have FGC, FUM, and EFI affiliated faith communities and organizations now in our investor base. And I think some of the previous speakers have talked about the fact that there can be varying objectives for investment. And that's one of the things that we're always working to balance. Our constituent investors depend on the investment income and the growth in their investments to fund their budgets, to fund their organizational missions. And there's a continuum of where people are in terms of their return expectations and their socially responsible expectations. And part of our job is to try and negotiate that for our large tent Quaker community. I would say that I think one of the things that we've tried to do is be responsive to our constituents. And as alluded to again earlier in the discussion, we have, I think, been responsive, starting the Green Fund back in 2014. And more recently, again, with input and concerns expressed by both New York Quarter and New York Yearly Meeting, have made the move to going fossil fuel free across all portfolios. And I will tell you that was early for some of our constituents and late for some of our constituents. And part of our goal is to work as best we can to satisfy all Quakers. And we're all Quakers on this presentation, so we presumably, and so we all know how difficult that can be. So let me leave that at that. This is a standard slide in our presentation. It talks about the fact that we do both negative and positive screening, as well as shareholder advocacy. But the things that I wanted to point out is that while we're focused today on environmental impact, it's important to remember that our screening, our Quaker Values screening, goes across all the testimonies and not just the stewardship concern. As you may know, we work with a number of managers in our various portfolios, including ESG, or well-recognized socially responsible investment managers and impact managers. And with every manager, we're applying our Quaker Values screen, and invariably, we're rejecting one or more companies that manager has in their standard portfolios. So even in the impact space, our Quaker Values lead us to exclude some companies that our impact managers otherwise are investing in for all of their impact-oriented clients. So just briefly on shareholder engagement, this is something we are very robust in. In 2019, 2020, we engaged 51 companies across 20 issue areas. And 26 of those engagements were resolutions where we actually filed a shareholder proposal. We were able to withdraw 12 of those 26, which means we came to agreement with the company about the issue or concern, which gives us an overall withdrawal rate of about 46%, which is right where the industry, the SRI industry, if you will, our peers are in terms of their withdrawals. One example of this in the environmental category, you'll hear me talk about ESG, and that stands for environmental, social, and governance issues. And Friends Fiduciary does shareholder engagement across that ESG spectrum. One recent example in the environmental category has been working on greenhouse gas emissions reductions with steel companies. We hold Nucor Steel. It's an electric arc steel manufacturer. And we engage them to reduce their greenhouse emission goals. They're already lower than many in terms of emissions, but we press them on setting energy conservation and renewable energy procurement goals. And we actually had a very positive result. They engaged in a power purchase agreement, a renewable power purchase agreement in Texas that will add the equivalent of electricity for 55,000 homes annually. So they're by committing to purchase renewable energy, they're helping to build out the infrastructure for further generation of renewable energy. So we saw that as a success with that company. So on the Green Impact Fund, we believe that to effectively address climate change, that involves all business sectors, not just the oil and gas. And that's kind of where we're starting from with this new fund. And this is all geared towards trying to work to limit warming to 1.5 degrees centigrade or less ideally. But on our current trajectory as an economy and as a world, we're not there yet. So this is where we're coming from in designing the Quaker Green Impact Fund. And so we're focusing on limiting carbon and investing in companies that are doing their part to build the just green future we need. This slide lists some of the frameworks and data sources that we're using for the Green Impact Fund. We're utilizing WRI, the World Resources Institute, and Project Drawdown frameworks for prioritizing industries and areas of focus. We're supplementing that with company data that we get through CDP. And I would note that Friends Fiduciary has been engaged and a member of CDP since 2012 or so. And it is now providing emissions data collected from the companies. We also use Bloomberg, a typical investment management tool. And then these priorities are further informed by the Sustainability Accounting Standards Board, or SASB, materiality map, which provides a starting point for identifying, in particular industries, what the primary sectors of, primary issues of concern are within a high impact sector. So we're pulling all these different frameworks together to use that to inform the work we're doing in this new fund. So I'm not going to spend too much time on this slide. With this new fund, we did want to move beyond just negative or exclusionary screening and direct capital to some solutions-based companies. And our impact managers within this new impact fund do that. And in doing that, they're taking a global perspective. I think it's not a surprise to most that the Europeans are ahead of us in many areas, and as are other countries around the world. We followed the same highly selective manager search process for this new fund that we have used for our existing products. And as noted, we work directly with our managers and interact with them. Let me move quickly because I want to make sure we have sufficient time. The impact managers that we're using in this fund take a thematic approach, and they're working across water, renewable energy, land use, and resource efficiency, and focused on each of these thematic areas for the green investing. And so, you know, one of the ways we would define green investing is looking at investing towards green water, sanitation, water conservation, et cetera, down through the spectrum. And I know there was a question about regenerative agriculture. One of the companies that we have rejected from an impact manager in the past has been around genetically modified seeds. So we do not invest in those. So an important piece of the Green Impact Fund in order to help reduce volatility and also to make the fund efficient from a cost perspective is a green index component, which we're calling Raising the Bar for the S&P 500. So this is a proprietary green index to add diversification to the impact managers. In this piece of the portfolio, and Rich will talk a little bit more about what the allocation of that is, we're favoring companies with science-based emissions reduction targets in line with the 1.5 degrees Celsius warming. We exclude high emitting industries, for example, transportation, meat production. Again, consistent with those frameworks we talked about with WRI and Project Drawdown. And then in the sectors that we are investing in, we're seeking the best environmental actors based on a score that we've developed in-house using a variety of factors. So with that, I'm going to turn it over to Rich to pick up from there.
Okay, thanks, Jeff. Good afternoon, friends. Hi, I'm Rich Kent, Chief Investment Officer at Friends Fiduciary. So the slide we're looking at on page 9 here is I'm going to talk a little bit about how we constructed the portfolio. So this is, as was noted earlier, a 100% equity fund. So this is a little different than the prior Quaker Green Fund. The Impact Fund is composed of 4 different portfolio manager accounts, all equity accounts. And we've diversified the exposure by going with different impact managers. And part of the reasoning behind that is basic, investing 101 when it comes to diversification. And that's trying to find the right combination of managers that don't always, their portfolios don't always act in the same way at the same time. You want to diversify your risk by having less correlated portfolios together. So that was part of our thinking. And I know that Diane Keefe earlier mentioned Essex Geos, which is one of the managers in this portfolio. And that manager taken alone can be quite volatile. So we thought it was important to try to control volatility by looking for other complementary managers in the space. And that's what we did. So this little pie chart on the upper right-hand corner here gives you the breakdown. So Jeff just talked about the green index portfolio, which is our Uber screened S&P 500. We've taken out over 230 names out of that portfolio, out of the S&P 500. That just gives you a sense of the degree of the rigor that we applied to those names. And that has about a 35% allocation in the pool. And then the 3 impact managers each have the remaining. There's one at 35% and 2 at 15%. The lower pie chart on this page, the blue pie chart, just gives you a sense of the different thematic areas that the impact managers are managing too, such as efficient transportation, renewable energies, clean technologies. So the question has been brought up several times, how do you define green investing? And there are a multitude of ways of doing that. And I think at its base, where the thematic managers are looking for cutting edge, sometimes disruptive technologies that are going to be taking the world into a more sustainable phase as we transition away from fossil fuels. So that's kind of how we think about it. And Jeff, if you go to the next page for me. So this green impact fund was built from the ground up. So it didn't exist prior to January 13th. So the return pattern that we're showing on this page is what we call a hypothetical historical pattern. And what we did is we took the actual returns of the managers and the funds that are composed in this portfolio, and we did a 5-year hypothetical at their weights in the portfolio. And these are the results we came up with as of the end of December 2020. So as I said, the fund was launched on January 13th. And so February will be its first full month of operation, and we'll begin publishing our investment returns on our website and in our materials once that occurs. So, you know, you look at these returns and the Green Impact Fund over the 1, 3, and 5 year, pretty attractive numbers. It is, of course, an all equity fund, so equities have done quite well. 2020 was actually a very strong year for growth managers, and the type of investments that the active managers in this portfolio engage in are more of a growthy nature. So they had a pretty good year themselves. We measure this against a benchmark that we have constructed that has, it's mentioned here in the footnote. It's 35% S&P 500 to reflect that 35% green index piece, and then 65% using the MSCI World Index. And that's a common benchmark we have found, particularly when we have interviewed and researched impact managers and clean tech managers and ESG managers. That's a very common benchmark that's used out there in the world, because a lot of these investments are internationally based. You know, the United States, no surprise, doesn't lead the world in environmental technologies and environmental Look, we have some very fine companies, no doubt, but Europe and other parts of Southeast Asia are doing quite well and have some excellent companies. So this portfolio has a pretty strong allocation to international as well, because of where we're finding the candidates for the portfolios. So the risk statistics part of the table, the lower part here, is just to give a sense of you know, risk. Standard deviation is a measure of volatility. And so this Green Impact Fund over the past 5 years has had a volatility measure of 15.55%, a little higher than the benchmark. Again, this is not too surprising given that the types of companies that are being invested in. But I would also tell you that the S&P, the green index component, helped actually bring that volatility down. So it is doing its piece for the portfolio. Jeff, if you want to go to the next page. So there are numerous UN sustainable development goals that are being addressed through the portfolio. We just listed a couple here, to sustainable cities and communities, and cited a couple companies that address that SDG, as well as a couple companies that address clean water and sanitation, another of the UN SDGs. Of the 17 SDGs, I would say they're close to at least half are addressed in this portfolio. But we're actually working on mapping that, and that'll be in some of our published materials going forward. So that's still in process at this point.
So Rich, your time, you did a great job. I should have given you a warning. My apologies. So we were a little over. I think what you've done is you've given us a tremendous amount I mean, I've been told by Will and Sam that your time was up earlier, but okay. I have to say that you have given us a huge amount of material for most of us on this call. You've given us, you know, well, yeah, probably easily twice as much as we could possibly suggest. So it's excellent. And so I want to thank you. That was absolutely fantastic. I really am excited about the idea of impact investing and what you've done with it, and that our own Quaker investment firm is you know, leading the way on this. So very, very happy to hear. So at this point, what I'd like to do, I'm going to take just 2 seconds to give a thank you to Kathy Mallon, who is the clerk of the Board of Managers of New England Yearly Meeting, who has been kind enough to join us. And I just wanted, you know, to say hi, and she's you know, put her video on. So thank you for coming. I appreciate it. And I believe there are some other people from, well, would you like to say a word or two, or Kathy?
No, thank you very much. This is really impressive, and I really appreciate it. Rob Spivey is also on from the New England Yearly Meeting Board of Managers as well. So thank you. I'm just can't wait to hear more about this. And I took a lot of notes. So I appreciate you inviting me. Thank you.
Thank you, Kathy. It was nice talking to you last night. And then also, I think we have some people possibly from Brooklyn yearly meeting and their Peace and Social Witness Committee. They may not want to unmask themselves, but yeah, I don't see anybody waving their hands. But anyhow, it's very nice to have at least we've made the contact with New England yearly meeting. Without saying any more, what I'd like to do is turn it over now to questioning. And we have our excellent questioner, and that is Albert Shu. Albert was involved in coming up with some really good questions last summer for some of the people who presented. And I asked him to be a questioner also. And I'll just give you a little background on him. He's the assistant treasurer for New York Yearly Meeting, treasurer of Purchase Quarter. And also he's a member of the New York Yearly Meeting Trustees Investment Subcommittee. He points out co-opted. He was an investment officer in a very large pension fund for a long time, as well as he was a United States investment officer for a large philanthropic organization. And right now he is a venture capitalist and a currency trader. And so I wanted Albert to be involved in the questioning to start off. So Albert, do you have some questions about some of the aspects that you of the presentations that you like to share at this point, or would you have you seen any in the chat that you think might be useful to be answered now?
Thanks, Peter. And thanks to all the previous speakers. Thanks for everyone that's attending. If anyone wants to jump in and ask questions, please don't let me hog up everything. I just have some specific questions, and I'm sure people have questions as well. For New York Quarterly Meeting, very interesting allocation. And my first question is, your allocation, was it set beforehand, or was your allocation a byproduct of the opportunistic elements that were available? So for example, in looking at where you have your fixed income like investments, it's about 39–40%. And then the remaining 60%, it looks like, is equities, with a portion in the Green Impact Fund of 16.3, and then in the Essex Geos Fund. So where is that other 40% or so invested in the equity component?
So we have about 14 million in the Growth and Income Fund of Friends Fiduciary, and then the 845,000 separate allocation into the Essex Geo Green Tech Fund is also equities, 100% equities, and then the Green Fund of Friends Fiduciary is.
Oh, you have to unmute yourself. Diane, unmute yourself.
Okay, so we have about 14 million in the Growth and Income Fund, which is about a 70-30 asset allocation between equities and debt. And then the Quaker Green Fund also, we had about 5 million in, and then we had 845,000, which is 100% equity in the Essex Geos. We actually, we have ranged between 70% equities and 30% fixed income, all the way down to as low as 35% equities over time. So when we get less optimistic about the future prospects of the stock market, we have a lower asset allocation to equities. And we also, we originally were thinking, before we had anywhere near 10% socially purposeful asset allocation, that we would get up to 10%. Now we're over 10% if you count everything that has been socially motivated or green motivated. But the state of the industry is that if an institution wants to, it could theoretically get up to 100% socially purposeful. And that really isn't making any statement about how that would be relative to equity and debt allocation. But we initially had a cap. Now, our next topic, I think Mike would agree that our clerk of our committee wants us to have the conversation about, is this enough or do we need to go further?
So the fixed income component yields, returns rather, low returns, obviously, in this type of environment. So, and your equity component, you would imagine, of course, returns a higher percentage. Do you guys have a specific target percentage out of your assets that you're shooting for, or is it just is it floating? Is it kind of 1 year it's 5%, 1 year it's 7%?
So we have, an investment policy statement that gives ranges for the different parts of the asset allocation, as do most other institutions, and it gives us discretion within. I think what we're facing in the last couple of years, maybe the last 5 years, is extraordinarily low interest rates. So Friends Fiduciary has also been facing that on their bond allocation. And we've decided that instead of just accepting those bond yields, we would try to do something more meaningful from a social perspective with that money, as long as we're not, increasing the default risk by a lot. So, Peter,
Yeah,
I don't
actually,
want to.
what I want to do is, because we're getting up, I think that's our limits. I would like to, if I'm not, Albert, I'd like to shift around. Maybe if Albert, he has a question, just have a 2-minute response, because I think Albert's gonna have more technical questions, and then I'm gonna ask permission to expand the question and answer period a little bit beyond that. But Diane, that was, once again, that was excellent. You've done a great, comprehensive review, and you've given us lots to chew on. So
I have a question for Friends Fiduciary, if I may. People in the chat were asking if there's any way individuals could invest. And I saw in the presentation, there was something about charitable gifts. Are you allowing individuals to make charitable gifts and then, have the annuity or whatever structure pay out to an individual, or is that only for organizations?
I'll answer that in less than 2 minutes. One, yes, we do work with individuals on planned gifts, so charitable gift annuities, charitable remainder trusts, and we can invest those assets, and we invest those consistent with the same values that we do the rest of our portfolios. We also, as a nonprofit, offer donor advised funds. And not only do we invest those consistent with Quaker values, but we do have some constraints around the gifting from those. So for example, we don't make a grant to the NRA or a white supremacy group like some for-profit donor advised funds have been caught doing. So those are 2 instances, and we're also looking, as we look forward, how we can begin to offer our services to the retail market to individuals, but that's a year or 2 off at least.
What's your minimum for those charitable activities?
Diane, I would like other people to jump in, but we're gonna have more time. So if you can come back with some questions there.
I'll put it in the chat.
Yeah, there we go. Right. And then, so what I would like to do is go back to Albert. Albert, do you have another question? And then we'll and I would like a short answer. Yeah, good.
Question for Friends Fiduciary. New York Quarterly Meeting has a very unique approach to the fixed income like side of their investing, which is very socially responsible and very specific. Are there any of the managers in the Green Impact Fund allocating any of their funds towards strategies like that? Or is it, more traditional screening, as you said, negative or positive of just large companies, mid companies, et cetera?
Yeah, I'll take that one. Well, Albert, I think there is a bit of the more traditional. If we're not going to hold the equity, we're not going to hold the bond either. That's the first thing I can say. So you would never find a unwanted bond in there. But I guess the evolution over the past few years has been our managers we're working with them to look for and seek out fixed income issues that are project oriented. So for instance, we won't invest in an electric utility that has coal as a big part of their fuel mix to create electricity. But we have come across bonds that have been issued by some of these electric utilities for alternative energy projects that they're working on. So we are looking for more proactive ways to work with those managers to find what we're calling green bonds or energy efficiency bonds. So that is one way we're doing it.
That's very helpful, because I look in the growth and income fund, at the holdings, and I see that utilities is this portion in there, and I always wondered, how you evaluate those, and that explains a lot to me. How much in assets does the green fund have right now? The green impact fund have right now?
About 28 million.
Okay.
The impact fund, yeah.
And then the growth and income fund has an allocation to that?
Correct.
A small percentage?
5%.
5%, okay.
5%.
All right. Any other questions for other people, please? I can keep going.
No, Albert, no, thank you, Albert.
There's plenty in the chat. There's a number of questions in the chat.
Albert, you've done a great job, and I want to thank you for that. And there are a few in the chat. One question, some people have asked more than one question. So I'm gonna, I think this is a Friends Fiduciary question from Matthew Bell, and that is the green component based upon a green index component based upon a tighter screening than the Quaker green, excuse me, somebody's, okay. I've been told her this has already been answered, never mind. Okay. Then Janet Soderberg, she asked, does Friends Fiduciary invest in regenerative farming? And another question for Friends Fiduciary, regenerative farming.
So what I've seen, at least for regenerative farming, is they're smaller project oriented type of situations. The managers we work with may invest in companies that aid regenerative farming, but I can't say we're not investing directly in regenerative farming. That would be more of a private equity allocation, I would think.
Okay. And then, well, here's a comment that I think is largely asked by Emily in the answered in the chat. And is that Emily, are you happy with those answers, or would you like some more? Another response from somebody on the panels here. Okay. All right. So for some reason, I thought there would be a lot more questions in the chat, and I guess there are fewer than I thought. I have one question, and that is, if somebody were to invest in like, let's say they had all their money in the growth and income fund, and they were to invest some of that money, take it out and put it in the Quaker Green Impact Fund. But they wanted to duplicate the ratio of stocks to bonds in their portfolio that they had before. So they're going to take some money out of a mixture of stocks and bonds that's in the Green Impact Fund, excuse me, the Quaker Growth and Income Impact Fund, and then they're going to put some of that into stocks. How would they balance it to keep that same balance? And what would you recommend? What do you offer?
I'm going to share screen quickly because we actually had a slide addressing this. Rich, do you want to then?
Sure.
Take it. Oops, sorry. There we go.
So what we did here in this table was the top line says baseline. That was assuming prior to the launch of the impact fund, assume you had 50% of your assets in the growth and income fund, 50% in the green fund. That would have given you you would have had 5.1% allocation to active impact stocks, largely through that allocation to Essex Geos, that's part of the green fund. The semi-annual distribution from that would have been 3.75%, 4% from growth and income, 3.5% from the green fund. After the green fund went away, the scenarios 1, 2, and 3 show just different combinations that give you different results. So for instance, let's say you wanted to keep the same effective distribution at 3.75%. You can invest 93% in the growth and income fund, 5% of the assets in the green impact fund, and 20% in bond fund. We're using the short-term bond fund for this illustration. That would have resulted in a higher exposure to impact stocks, but would have kept your distribution the same at 3.75%, and your asset mix would have been the same at 75% equity, 25% fixed income. And so scenarios 2 and 3 in this table, and by the way, we can make these slides available after the meeting. Scenarios 2 and 3 also keep the equity fixed income allocation 75-25. But what you'll notice is as the green impact proportion increases, the annual distribution goes down. That's because the green impact fund does not operate with a distribution policy. But having said that, folks you can always withdraw out of the fund at any point in time, or out of any of our bond funds. So, but it just doesn't have an automatic standard distribution policy. So
And I would just jump in here and add that we'd be happy to talk through scenarios with individual constituent groups, if that would be helpful. So individual finance committee members or monthly meetings.
Yep. So I just one follow up about when you addressed our trustees in I think it was November, and when you were asked basically what would you recommend to New York yearly meeting, for instance, how much would you recommend we put into the Quaker Green Impact Fund? And do you have a recommendation about that, or is that something you really can't make a recommendation about? How would you approach that now? That question.
I think it really is up to the individual circumstances of the group and what their objective is, what's the risk tolerance, what other funds might be out there that can balance any increase in volatility that might be taken on. I mean, it really sort of depends, I think. I'm not trying to be off-putting, but I think it depends.
I would just jump in and say, I think Diane's description of the quarter's kind of deliberations around this were representative of a thoughtful approach that we would recommend for groups trying to find that balance. There's no single answer for every constituent. That we know for sure.
Okay, well, it's now 3:31, and what I was going to do, I will have a little wrap up, but I would ask for if those panelists who can, if they can stick around, we will have questions afterwards. We did this last summer. We had questions for another half an hour afterwards, and then we did cut it off at that point. But pretty much everybody stuck around. So I think there will be more questions. So I guess in conclusion, although I hope there'll be more questions, I just want to thank everybody who came today on a not so snowy day, or snow-covered day in February in the afternoon to join us for this panel. I want to thank the panelists for their excellent presentations. I hope that the people who participated have a slice of what how a monthly meeting approached investing in the Quaker Green Impact Fund, and also how a very large quarterly meeting approached it. I hope it's more accessible now to you. And I hope you have more of an understanding of the of our Friends Fiduciary Quaker Green Impact Fund. I just want to also thank everybody who really helped behind this. You know, Sam and Will with the tech support, and also Sally, my co-facilitator, for all the work she did with me, and also the you know, Margaret McCaslin and the other members of our climate justice working group. We meet every week, and we have some great things going. So check out, you know, stay in touch with us. We'll stay in touch with you. And if you want information about the Quaker Green Impact Fund, and you want to see the slides they presented, you can email Friends Fiduciary at the email address that's in the chat. If you haven't finished the poll, please finish that. And I'm just going to ask my other panelists, or do they have any additional comments at this point before we close?
I would just like to give a shout out to Friends Fiduciary in terms of their ability to help friends readjust what they own. And I will just say a brief story about somebody who was an Earth Care witness and had a big chunk of inherited Exxon Mobil stock a long time ago and said, what should I do with it? And I said, donate it. Donate it to charity, because as soon as you donate it, they'll sell it. And you don't have to pay the taxes on it if you're giving it to charity. So that's what those donor advised funds do. And the other thing, many people, I know my husband and I are redoing our estate plan and our wills in response to COVID. It's a great time to look at which Quaker organizations you really want to support as part of your legacy, and you can set up a charitable remainder trust or a charitable gift annuity so that you can still live off income, but eventually the charity gets your money, whatever's left over when you die. So there's a lot of interesting things you can do to remove yourself from things that you don't want to pay the taxes on.
Thank you, Diane. Any other panelists? Mike?
I have a quick comment, just a plug for the Climate Justice Working Group. One of our co-clerks is here today, Margaret McCaslin. We've got another co-clerk, Silka Jackson. You can reach out to us. You can reach out to Peter. You can reach out to Sally or me or Diane, any of the names that you see associated with it here, or the emails on the invites that you've been receiving about this. If you are interested in doing work related to climate justice within the scope of New York Yearly Meeting, and if you want to be on our mailing list, keep in mind that climate justice is a broad and intersectional topic that covers a lot of areas beyond direct investment. And if your meeting is getting involved in or looking for support, interest, or input on any projects, reach out, because we're a new working group and we're interested in building those connections and in helping find the people who are deep wells of action and knowledge, and helping them meet and work together.
Thank you, Will. Okay, well, I want to thank everybody, and we will, once again, Friends Fiduciary, excellent presentation. Thank you, New York Quarterly Meeting, and also thank you, you know, Saratoga Friends Meeting. It was truly amazing. I learned a lot. It's excellent, and we will, I think we'll segue right into questions, and I'm going to ask there a number of questions from Tim Connolly. I think we asked answered one of his already. Tim, do you want to pick one of your questions, if you're still here, that you'd like us to ask? You haven't asked yet? Tim, are you there? Okay, I guess Tim is not with us. Okay. And then I think Janet, I know that question we've answered, right? Let's see. Oh, and Matthew Hackman. I think, has that been answered? Investment, okay. The question is investment in community loan funds. I believe, Diane, you addressed that? Yes, I think Diane.
Actually, I'd love to ask Friends Fiduciary whether they would consider an asset allocation to community development financial institutions as part of the growth and income fund at some point.
The short answer is yes. This past year in 2020, we made our first foray with a local CDFI. It was very modest, $500,000. But as you know, one of the challenges is CDFIs tend to be place-based, geographically oriented, and we have a national footprint. So we're still, the investment we made actually spans a wide part of the East Coast, including New York, all the way down to Atlanta, where we have constituents. So we were comfortable doing that, and we're looking at ways of doing more of that in a way that reflects the broad geographic diversity of our constituents. Because everybody wants investments in their own communities, and understandably so.
Excellent, excellent. So at this point, if people want to, you can raise your hands and we'll recognize you from the floor. So if we have a couple of questions and then I'll go back to Albert. I know Albert must have at least one or two more questions. Okay, Matthew Bell, go ahead. You have to unmute yourself. There we go.
Yeah, thank you. This has been a hugely interesting session altogether. Thank you so much for organizing it. I have a question for Friends Fiduciary. I noticed in the environmental screen you listed banks. And you know, I know from my friends at 350.org and Extinction Rebellion are very concerned about financial institutions that are invested in fossil fuels. So how deep can you go in the screening? I mean, you know, a large bank will have a large portfolio of loans. So how much do you look at whether they're engaged in fossil fuel projects and at what level?
Great, thanks. Great question, Matthew. It is indeed challenging, particularly large banks, large financial institutions have a broad reach. The approach we've taken is screening out those those banks that are the largest fossil fuel financiers. And we're basing our data on reporting that RAND, the Rainforest Action Network, produces. They're one of the leaders in terms of looking at bank financing. You know, we had worked with them back in 2011, 2012, when we started engaging with PNC Bank around the mountaintop removal financing. And you may know through our engagement along with other investors, PNC stopped that financing. So yeah, so that's the approach we've taken. Now, that said, some of our bank holdings would likely have some level of funding to fossil fuel companies, but we have excluded those major financiers, which knocks out a good portion of the largest banks.
Thank you, Jeffrey, for your response, and thank you, Matthew. So is there another question from the floor that someone would like to ask? If you raise your hand, we can put you in the discussion. Okay, and I don't see anybody. I'll just take 1 second. I want to thank Lynn Murray, who is our clerk of trustees at Purchase Meeting. We are hopefully going to be signing in the next month or two whether to have an allocation going into the Quaker Green Impact Fund, and if so, how much. And I'm really glad she's here along with Linda Kyle, another member of our trustees. And I know and also Devlin, there we go. And I believe there was one other who I don't know. Well, Margaret used to be in our meeting, but okay, there we go. Michael Lesser.
Yeah, just a silly question for Friends Fiduciary. It's a little bit confusing with your acronyms. You've got the Quaker Green Investment Fund, you have the Quaker Green Impact Fund, and they both have the same initials. You might want to consider making it a little bit less confusing.
I noticed that myself. I was writing that. But it says what it is, that's for sure. No question about that. So does anybody else? Just, you know, any other? Good. Michael, you have another question, or you hadn't lowered your hand? Okay, so is that another one, Michael? No, we'll come back to you. Okay, then. So I don't see another hand up. So we'll go back to Albert. Oh, Kathy, you have a question. Go ahead. Yep.
I don't know who Kathy is, but I think it was me raising my hand.
Sally, I'm so
I
sorry.
saw in the chat that
Been a long
Rebecca
day.
Rice had a comment or a question about regenerative farming. Rebecca, did that get answered, or would you like to talk about it?
I actually I was curious because I had seen that agriculture was one of the things that they listed in this fund. And since we've invested in it, I wanted to make sure that it didn't involve anything genetically modified or pesticide or insecticide-ish. And it sounds like they are making an effort in that regard. But I would love to have a less public conversation about some approaches, because there's some really bad large scale stuff happening right now that does include very large land buy-ups by people like Bill Gates. And since we know that he has pushed very, very hard for genetically modified seeds and processes in a lot of places in the guise of more productivity, which it never turns out to have, I have some concerns about very, very specific potential investments. And I'd be more than happy as a farmer, as a longtime organic farmer. I'm certified naturally grown. I do peer reviews for all kinds of other farmers. That's how they do it there for their certifications. Happy to look at any of the agricultural investments with you and tell you background stories that I've been following for a long time on a lot of those possibilities. So yeah, and you can reach me. I'm yeah, my email address is very publicly available.
Excellent, very good. Okay, so I'd like to ask from the chat, Will or Sam. I don't know if Sam's still here. Was there anything that I missed that you want to put in?
We're both still here, and I think that you've addressed all of the questions we recorded for people who are still here, but this is a good time to ask anybody, unmute your mic and ask a question if you got one.
Yeah, raise your hand, and particularly if you haven't asked a question, please ask a question now, and even if it's a half-formed one, let's get it out there so we can talk about it. Well, if no, okay, so think about it. Albert, I know you had at least one question. Did you have a question for Saratoga by any chance, Albert?
I did not. My apologies, Saratoga.
No, that's okay.
I have another question, if you'll allow me, about even though Tim is gone, I think it's a really good question, and I'd love to hear Rich or Jeff respond to it. That there's a traditional argument that if you pull out too much of the S&P 500 with your moral judgments, you end up with not enough diversification by industry in order to get a proper risk-reward trade-off in your investment decisions. And yet my understanding from the research is that the benefits of diversification decline after about 18 different securities are selected, assuming that they're selected across many industries. So I'm wondering what additional thoughts you guys have about what return characteristics you think you can achieve in the green business.
The way we've approached that, Diane, is to so we have, of course, taken out a lot of companies out of the S&P 500, but if we just removed the companies and invested like equal weight across what was left, I think you would get the kind of unexpected tracking error that you might not want against the S&P 500. I don't know if, can you hear me okay? It says my connection is unstable.
We can hear you.
Okay. So what we do is we go through this optimization process, which is a mathematical algorithm that rebalances the remaining names to match the characteristics of those names to match the characteristics of the S&P 500. And the whole purpose of doing that is to reduce the expected tracking error to the S&P 500. It comes pretty close, actually. So when we rebalanced the green index fund for this index component for the impact fund, the expected tracking error came in at plus or minus 1.12%, which is really, really excellent given the fact that you're taking close to 50% of the names out. So that's how we're addressing it. I mean, I think you're right on. You have to be aware of it. And it's something we're going to keep our eye on. I think optimization is the kind of thing that can be adjusted over time as well. So we'll talk to the manager about what factors they use in their optimization process, and hope make it better and better as we move through time.
Okay, thank you, Rich. Okay, I see Chuck, you have your hand up. Would you like to ask your question?
Yeah, to get an idea of what you're doing, say, let's just talk automotive. If you were investing in automotive straight, would you invest like only in Tesla, or would you invest in like Ford and General Motors, even though they have big gas guzzlers?
So we're favoring automakers that are producing more electric vehicles. So Tesla would be preferred. And Rich, I don't know if you have other specifics. I know as part of our screening, we included some auto companies and some not, but I'm not really.
Well, obviously not General Motors due to their military exposure.
Right.
And there's some component companies we're invested in, and in the impact, the new green index, I believe we've taken Ford out as well of that one.
Because?
Due to their, as an industry, you know, well, they're part of an industry that is highly carbon pollutive, and they need to become more, their fleet needs to become more electric, basically.
Thank you. You got to the guts of my question.
Sorry it took so long.
Well, this has been very good. I think it's been a lot of information that's flown back and forth, and I guess I will. If people want to have a discussion, people can talk. I don't know that you need a moderator at this point, and if people want to. Of course, Diane, what you say is very interesting. We give people just a space to say something, and then I think thank you, Jeff. Thank you, Rich, and thank you, everybody from Saratoga, and also Diane for coming.
I wanted to thank everybody also, but I also wanted to respond to Rebecca's interest and willingness to help. So the investments of Friends Fiduciary, and to a great extent, the investments of New York Quarterly Meeting, are tilted toward very, very large companies. And the world has not evolved yet to scale organic agriculture and regenerative agriculture. So most of the companies that are doing that work are not what they call investable companies, except, by angel investors. And angel investors have to be accredited, meaning they have to have at least $1 million net worth in order to even see these companies, because the law says that only sophisticated investors who can afford to lose all the money that they put in can even think about investing in these companies. But there is a lot of work being done, and technology is changing really quickly. So for instance, Danone, the French dairy company, has been really trying to transform what they're doing with soil. They're trying to reinvest in carbon sequestration in soil, even though there are many ESG funds, environmental, social, and governance funds that don't invest in Danone because they have a huge water business. So they have a bottled water business. So when you get into big scale companies, each company has to be looked at, and you have to decide whether the evil that they're doing on one side of their business is so bad that you can't even invest in the good stuff, the green shoots of innovation that are happening in another side of their business. But when you're dealing with smaller companies, there's more of a chance that what they're actually doing is important. And I just wanted to comment on the, health and well-being, for instance, within the green impact. Just to give you an example, I'm an angel investor, meaning I'm one of those people who gets to look at the startup companies. And I'm investing in a new company that is enabling people who are being prescribed opioids for pain control to control how many they're allowed to have by the number of hours. And they only get a passcode through the app if they are obeying the proper dosage. And this is a way to decrease opioid addiction from the get-go. So there's all kinds of sort of new solutions, not only in sustainable ag, but in healthcare to solve some of the problems that we have. And the people who used to call themselves SRI investors are now calling themselves impact investors. And the people who used to do nothing are now calling themselves ESG, which is environmental, social, and governance. And because it's very much still oriented toward the very big companies and moving on the margins toward better investments. But there is a problem in the sense that most of the businesses that have gained, hundreds of billions of dollars of scale are not doing what we would want them to be doing on the environment.
Yeah. Yeah. And I'm very painfully aware that seed companies, for example, have been getting consolidated, and it's really damaging the seed supply. And so the question is there a way to be investing in small seed companies without being $1 million angel investor, or, and does Friends Fiduciary have enough assets to be able to do an angel in something that Friends decided was really important and worth taking a risk on? That would be a possibility. I could imagine that we could all get together and decide that $1 million to ensure that there was, that there were copious amounts of organic seed being produced and stored properly and packaged and distributed would be worth it.
So Friends Fiduciary could be involved, and that's called venture capital. And there are socially responsible venture capitalists, and Friends Fiduciary hasn't done that historically, but maybe as they grow toward $1 billion, they'll decide that they can look to a socially purposeful venture capital allocation, because it can make a lot of money. If you pick the right company, they say that out of 20 venture capital investments, 17 of them will go out of business. 2 of them will just make the money you put back in, and then the 20th one will actually make enough money to justify the whole other thing. That's sort of the standard conventional wisdom about how it works. So you have to be willing to lose a ton of money on the seed capital investments, but those are the ones that really drive innovation.
I would just add that at Friends Fiduciary, we're committed to continuing to evolve. And I think those who've known us for a long time have seen that over the last 10 years or so. And I think that's going to continue. Our overall portfolio is going to look more and more like the Green Impact Fund over time, just as our Growth and Income Fund went fossil fuel free. So we'll continue to evolve as Friends move on these issues. So.
Thank you. Well, we have, I guess, like 3 more minutes. And this, Sam and Will stayed with us, and so I'll probably close it in 3 minutes. And thank you for all your comments, Diane. And I think Diane actually should do a special video and edited and everything, because I think Diane is a one person impact champion there for sure. I've learned a lot by talking to Diane's very modest. I talked to Mike Slagle and he told me the real story. So I'm like,
Well, the thing is, there were a bunch of us that were thought of as hippies early back in the day. And we used to congregate. The first socially responsible investment conference had 12 people at it. And now there are thousands of people going to these conferences, you know, and, you know, just like you would have thought we were all in the hot tub at the first conference. But by the time it got very big, we weren't all in the hot tub.
you could have fit in a hot tub. That's a good, I like that analogy. I also want to just thank Deb Wood for coming. She's our clerk administrative counsel, and I'm glad she's coming to listen to this. She's part of our big decision. And then I see Kathy Slattery's here and Jean Saylor, and hope I'm pronouncing that correctly. And and Kathleen Keep. So they're fantastic people. I'm really glad that everybody came. So if there's any closing comment that anybody would like to throw in here, that would be this would be the time to do it. And otherwise, we'll let our.
Yeah, I'd just like to say thank you so much, everyone. And it sounds like, Peter, you're doing the romper room, and I see Kathy Slattery out there.
Yeah, right.
It's good. No, everyone and here, thank you for sharing your knowledge, and I've learned so much and feel inspired to, you know, go forward and look into some of these things. And so I thank all our panelists and all our committee members that have contributed so much, and all that attended and you know, stuck with us. So thank you.
Yeah, thank you very much.